Some of the comments that we saw from Finance Minister Pravin Gordhan, and of course with regards to the local currency and exchange rates.
Our monetary policy designed to target inflation has been conducted successfully by the South African Reserve Bank, achieving the current low rate of inflation and interest rates. Fiscal and monetary policy will continue to work in partnership. Monetary policy conducted by the Reserve Bank will continue to be focused on controlling inflation, and we will continue to ensure that fiscal policy is countercyclical within a sustainable long-term framework. Movements in the exchange rate affect different sectors of the economy in different ways and present difficulties in macroeconomic policy for many countries. Recognizing the impact of the rand's strength on manufacturing industry in particular, we announced measures in October during the MTBPS to moderate the potential effect of capital inflows. Firstly, we said that foreign exchange regulations were amended to permit greater foreign investment by South African institutions and individuals. Second, we stepped up foreign exchange purchases by the Reserve Bank, which have helped to moderate upward pressure on the rand. As a result of these policy adjustments, and in line with shifts in investor sentiment globally, the rand depreciated from December 2010 to February 2011 by about 10% on a trade-weighted basis.
Joining us to discuss the economic impacts of the budget is Attard Montalto, Emerging Markets Economist at Nomura International, Johny Lambridis, Element Investment Managers as our market watcher, and of course Justin Knightley, a trader at Nedbank Capital, for a look at the Forex market. Thank you, gentlemen, for joining me today. Peter, let's start off with you. Let's get an international perspective on Finance Minister Pravin Gordhan's statement. No real surprises coming to the fore, but one rhetoric he did mention a few times: inclusive growth and of course a big focus on jobs.
Well, exactly. I think there's no surprise in terms of the concentration on growth at all. What is surprising, though, is what's happened to the budget deficit projections. And it seems very odd, really. If you think back to the budget last year, we had quite a rapid, steep decline in the budget deficit. That was accelerated in many ways in the medium-term budget at the end of last year. But now we seem to have actually a much slower pace of deficit reduction in this budget, and it seems rather odd in then why they had such a fast pace of consolidation in the medium-term budget in October. I mean, we know why that's come about. It's through extra spending on investment, on labour-intensive investment, on jobs. But there's also hidden in the budget, there is a small tax cut as well going on in income tax, being offset partly by some of the VAT and excise duty rises. But overall, I think that's a big question of why this series of projections has come about as it has. I think it's also a slight surprise to some foreign investors in that the funding requirement is now higher over the next few years for the public sector. There was a consensus, I think, in the market that I didn't share actually, but there was some consensus in the market that actually the funding requirement might be a little bit lower.
Well, Peter, I mean, when you look at the debt that could plague the country going forward and the spending, we're looking at spending hitting around 1.2 trillion rand by 2013, 2014. Do you think that's going to be a negative, and do you see revenues rising in tandem with the increase in spending?
Well, I think the key uncertainty around the outlook is further developmental state policies such as national health insurance. I think what they presented at the moment is once again achievable. I mean, before this budget, I was highlighting some of the upside risks there were to spending on some of these priorities, such as jobs, and that's now come through. But the big uncertainty really still is national health insurance, and the choice they have basically between raising VAT and raising income tax to cover that, or perhaps allowing the deficit to pull back even slower in order to afford that national health insurance. Therefore, I think still the risks very much to the budget deficit, to the funding requirement, are to the upside in the next few years.
Very good afternoon to you. Just taking a look at how the rand is performing at this point. We're sitting at 7.09, 7.10 to the US dollar. Markets coming under pressure on the equity front, but really what we're seeing coming through in Europe and in the US, the rand has been quite sensitive to some of the commentary made by Finance Minister Pravin Gordhan, though.
Yes, indeed. If we were to summarize the budget, it was rand-friendly, but probably unfriendly to the bond market. The reason the rand probably gained after Pravin Gordhan's comments is that he asserted that we were unlikely to see further intervention in terms of a tax on market outflows like Brazil, Thailand, and Korea has already implemented. Although they did say they were.
He did say he'd keep a close watch on those economies as well.
That's probably a shot across the bows to say, you know, we are monitoring it, but of course we are not implementing it in South Africa. The reason we're not implementing it, of course, is that we rely on those inflows to fund the gap that Peter was talking about. So we can't, of course, bite the hand that feeds us. On the bond side, we saw a bit of a pullback in the bonds because of, as Peter mentioned, the budget deficit was a lot higher than expected, 5.3%. Our economists at Nedbank had suggested as low as 4.6%. The reason is, of course, we've got to pay for that. And how do we pay for things? We issue bonds. And the issuance of bonds will be predominantly in the long end of the curve. And that's why we saw the gap, 186, 157 bond, going higher, out to about 108 points when I left the office, previously below 100 points. So, yeah.
Johny, if we could just get your perspective in terms of how it's impacted the equity market. We were chatting to David Shapiro yesterday, and he was saying that the investor community doesn't really pay much attention to the budget. I suppose when you look at what's happening on the dividend tax perspective, more clarity there, so perhaps that could be good news from a corporate perspective.
Look, I think there's quite a lot to be taken away from the budget for equities, and not necessarily market moving as it was for bonds or currencies. But the budget was slightly more expansionary, which, if that is implemented correctly, that could be sort of not long-term positive for the equity market. But I guess the concern on the government side has been on sort of delivery and implementation in the last couple of years.
Peter, your view on that in terms of implementation, and also the fact that we've seen an impact coming through on the local currency and the bond market, but again, equity is really susceptible to what we see on a global level.
Well, I think the currency point is very interesting, actually, and broadly there was a consensus, I think, in the market that something would have been done, albeit very small baby steps. I think there was an expectation that there'd be some small measures, and clearly the market's been disappointed around that. South Africa is now very severely lagging in this time zone. Turkey and Israel, which should be much more aggressive on the currency policy front. And I think it's also slightly odd of Pravin Gordhan to make this point that the rand has depreciated from the start of the year to now. In fact, we're actually at roughly the same level in dollar rand we were at the end of November. It's because there was such a strong appreciation in December. It is true that the SARB has been in there more aggressively since the start of the year, helped by Treasury sterilisation deposits and also the conversion by National Treasury of local currency into foreign currency deposits as well. But broadly, we haven't actually got that far since the medium-term budget. There is still more to do on the currency. Of course, I take the point that South Africa obviously has to fund itself. You don't want to bite that hand off, as the other guest said, but you do actually need to lean against that flow, I think, and encourage a little bit more outflow, a little bit more profit taking on the long bond position that has been built up over the last 2 years or so. And that's why the market was disappointed, and hence the rand strength that we've seen.
Justin, we were chatting a little earlier, and you were saying that we actually saw the Reserve Bank being quite active today in accumulating reserves. And some of the comments and rhetoric we did see from Pravin Gordhan, perhaps we thought it could allude to the fact that they could put the brakes on reserve accumulation. So perhaps we were wrong there. Yeah,
if you look at the rand reserves that we've converted into dollars, you just have to look at the difference between the last two figures to see over $1 billion has been accumulated. And the Reserve Bank says they accumulate those dollars as reserves, but of course the fact that it tends to weaken the currency doesn't go unnoticed. The Reserve Bank governor says we accumulate just for reserve purposes. I tend to think not. They are very well aware of the necessity to weaken the rand, and that is certainly at play, and we have seen a certain amount of that from the Reserve Bank, yes.
And Johny, I mean, when you look at some of the comments made with regards to inflation, he was saying that the central bank's mandate is to keep inflation in check of between 3% and 6%, and he is very confident that Joel markets will ensure that going forward, given the price pressures that we see on a global level. So another comment towards industry that one doesn't need to worry about being pushed to the left and perhaps doing away with the inflation target in South Africa.
I guess we would disagree with the Minister's comments on inflation. He doesn't see inflation breaching 6% by 2013. We think there's a high probability it will breach 6% by the end of the year. I mean, we see oil already sort of nearly at $110 per barrel. They've increased the road accident levy, which will impact the fuel price. there's a lot of other sort of taxes coming through for the consumer. So we think there's a risk to inflation, and that the minister's underplaying those risks in South Africa.
Peter, what do you make of that? What have you priced in from an inflation perspective? And also given the fact we've got cost pressures all around, but we've also got around 8 billion rand that's going to be put back into South African consumers' hand from the tax breaks that we've been seeing on the income front coming through.
Well, I think it highlights the coming inflation pressures going forwards. A little bit of extra fiscal stimulus in terms of those tax breaks. And I think it's also interesting that the new growth plan didn't really feature in this that much at all in terms of the macroeconomic shift that's meant to occur under the new growth plan, away from fiscal policy doing the heavy lifting into monetary policy. I mean, the SARB is going to look at these numbers today. They're going to see a larger deficit. And it's not going to make them suddenly hike, very aggressively or anything like that. But it's just going to, I think, make them think about the impact of fiscal policy in the economy, and also together with the weakening rand from their reserve accumulations. But I think we are obviously seeing strong real wage growth in the economy, a slight loosening of credit conditions as well, and this will just feed into that, and I think particularly in the second half of the year cause core inflation to start going higher. And so it makes my sort of forecast over the medium term of inflation up to around 6.5% by the end of next year. Still quite comfortable with that. Obviously, the SARB and the National Treasury are more comfortable. The National Treasury saying today at around 5.50 in the long term.
Johny, I mean, looking at the rand that we've been looking at over the past couple of weeks, we've seen immense volatility. We hit 734. We're sitting at around 710. We're hearing of reserve accumulation. We've got worries coming through in the Middle East as well. In terms of what companies are starting to factor in going forward as a norm when it comes to the currency, what do you think we're looking at? And you're alluding to a much higher inflation environment than what the Finance Ministry and the Reserve Bank is pricing in. What are you looking at this point?
I mean, generally, where the rand finished the year at in 2010, we thought was sort of overvalued territory, moving towards the 734, like you mentioned, which we touched the other day. In our view, is still slightly overvalued. So we would sort of see the rand drifting from where we are at the moment.
And your view on that, Justin? I mean, 750, how soon can we hit that? And do you see the same inflationary pressures coming through the forward rate markets, looking at a higher interest rate environment towards the end of the year? Do you think that could be a possibility?
Well, I mean, I've been in this market quite a long time, and this is nothing compared with 1998, when on one day I saw the rand go from 10 to 13.86 in one morning. So the kind of movement we've seen is, it certainly doesn't scare an old hand like myself, but certainly weakening rand, oil price, inflationary pressures are growing. There's no question. I think perhaps we will possibly overshoot the rather modest projections of the Reserve Bank. So possibly we are looking at an inflation overshoot, interest rate hikes, possibly towards the end of this year. The FRA market, which is often the best judge of where the interest rates are going, has already priced in 100% chance of a hike by the end of this year.
Johny, is that what you're seeing as well, a hike by the end of the year?
We could, in our views, there's a sort of a chance that if the rand does actually move towards 8 to the dollar, we could see double-digit inflation, and we would definitely get that sort of interest rate hike coming through. Generally, the FRAs are quite good over the near term to forecast the interest rates, but have been sort of quite a bad predictor of sort of longer term interest rate expectations. In general, when inflation is moving up, the FRAs lag the curve.
Peter, what are you pricing in? Does it change your outlook for the rand and for inflation in the country? We know you have been a rand bear for some time. Any changes on your views?
Well, we're definitely keeping our November rate hike call. As we can see, it's priced into the market now, but I think in terms of economist expectations, the consensus is still probably for a January hike instead. But I think there's enough pressure coming in the system, enough recovery in GDP and retail sales, that sort of thing, to see demand side pressures start to emerge towards the end of the year, and hence that hike there. I mean, we've kept our 8 year-end dollar rand forecast for quite some time. I think given events in the Middle East and what's going on there and the impact that can have on oil especially, there's going to be quite a large terms of trade shock which can feed through into the current account. I think people are going to be surprised to the upside by how fast the current account deficit can turn around back to sort of minus 4.5–5% handles. by the start of next year, and that's going to be a strong negative pressure on the rand, and combined with perhaps some more negative risk sentiment around the Middle East. So we've kept that year-end 8 forecast there definitely, and still negative on inflation, seeing it out of target during next year.
Gentlemen, thank you so very much for joining me today. Much appreciated. A big thank you to Peter Attard Montalto from Nomura International, Johny Lambridis, Element Investment Managers, and Justin Kightley, trader at Nedbank Capital.